Hello and welcome to another Simple Trading Ideas trading tutorial. In today's Simple Trading Ideas trading tutorial, we're going to explore breakout trading strategies. We're just going to go over a couple of simple ones so that you can get a feel for it, and getting a feel for it by looking at the examples will serve as a starting point, a foundation for your own research and analysis. So let's start off with why it's called a breakout. Well, it's called a breakout because it basically moves outside or breaks free from a particular trading range. Now here we've drawn two horizontal lines, okay? And these two horizontal lines at this particular point represent the highest high as well as the lowest low for the last 10 periods. In this case, as we're looking at the QQQ, this is a daily chart. Okay, so there's the highest high, and you can see the highest high is holding. We come back down here. The lowest low gets penetrated. Now, in some forms of breakout trading, you could actually sell short at this particular point, and then the market travels back up. You have another option, and that is to sell short only when there is a close below this level. So let's take a look at the two different techniques. Here, as you can see, if we were just going with the penetration of that low, the breakout of that low, we would be short on this particular bar in this particular day. The market would travel back up, and they would come back down and fall back through the floor, and we would continue at that point to be short. Alternatively, if we waited for a close below here, then we would have to, that didn't quite cut it, did it? No, it did not. We would have to wait for the close, and that would be, this would actually be the level of the first close below this particular lower level. And so we would actually be short on this bar, and we travel down for a bit, and we bounce back up. Up here we currently be in a loss, and we travel back down, and selling short ended up being a good thing in this particular case. And so we've got two different scenarios. Now, some will prefer to trade based upon a close below the lower level of the range or a close above the higher level of the range to buy. And some will simply wait for the price to either hit that level or go a particular distance below that level. And it might be, in this case of the QQQ, it may be 25 or 50 cents below that particular level. And the reason this is done is to attempt to minimize what are known as false breakouts. You see in this particular case, if a breakout goes down through and then comes back up into this range, you could say, well, that was a false breakout because there was no follow through, no continuation of the breakout to the downside. Now, a couple other interesting things to discuss with regard to breakouts is the fact that there's a range. And this range is defined by the number of periods, and in this case, the number of days. So this is 10 days based upon the last 10 days, okay, the highest high and the lowest low. If that range, we expanded that range to the last 20 days, then you can see highest high and the lowest low, we'd move down here. So the more periods you use, the greater the distance between the top of the range and the bottom of the range would be. Now, this is important for a number of reasons. The greater the number of periods, in this case the greater the number of days, will typically yield fewer trades than if we have, say, a 5-day or 5-period range for our breakout. Also, many breakout traders use one side for the breakout, such as down here we have a breakout to the downside. So And the other side of the range, the other end of the range, would be used for risk control and would end up being the stop loss. So traders who are using this particular method are particularly aware of the distance between the top end of the range and the bottom end of the range, because that is defining the level of risk. And here we got like 67 and a half, say 68 and a half, 69 and a half. Okay, so we're talking about a range there of $3 per traded share. Okay, and if we expanded that range in this particular case, if I go down here, actually let's move this down here. Okay, so that's a 40 period range. Okay, and let's take a look at what type of risk if we'd be using the other side of this particular range, the top of the range, as our stop loss. Okay, so it would be 63. I'll say 1, 2, 3, 4, 5, 6, 7.5, $7.50 per share. So that's markedly different. So those who are trading a breakout and using the other side of the range as their stop need to be aware of the distance between the top of the range and the bottom of the range, and how that fits into their own particular risk control parameters. Okay, so let's pop back up here. Let's do the little simple 10 period right here. Okay, so another name for a breakout of this nature would be called a channel breakout, and that's basically because you have prices traveling in between the top and the bottom levels, and the top and bottom levels form a channel. So these prices are trading within the price channel. These prices moved outside of the price channel, have broken out of the price channel, and that is typically how that works. So breakouts are good and extremely effective ways to trade virtually any market in any time frame. Quite naturally, there has to be research done in order to determine the best set of parameters which will give you the greatest probability for success, and that's going to include your entry parameters, your exit parameters, the risk control, etc. So this has been a very basic introduction to breakout trading strategies. Thank you. Thank you for taking the time to join us for another Simple Trading Ideas trading tutorial. Please feel free to come to our website at www.simpletradingideas.com for more great trading information. Thank you, and have a phenomenal day.